Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about China Lesso Group Holdings Limited annual report. China Lesso Group Holdings Limited offers a diverse range of businesses and services across various sectors. At the core of its operations are piping and building materials manufacturing, which includes pipeline system solutions for municipal engineering, water supply, drainage, power line communication, and heating. The company also provides specialized products and services for specific industries such as agriculture, mining, chemicals, food, oil and gas, and utilities. These include water-saving irrigation systems, aquaculture platforms, pontoon systems, and firefighting pipelines. In addition to manufacturing, China Lesso Group Holdings Limited is involved in property development, e-commerce platform operations, logistics services, and internet data provision. The company also engages in the manufacture and sale of various building materials, including aluminum profiles, monocrystalline silicon, fertilizer, and chemical products. Furthermore, the group offers mosaic tile production, sports event hosting, property investment, power generation technical services, and internet data services. Its customer base includes independent distributors, civil contractors, property developers, utility companies, and municipalities. With a presence in China and internationally, China Lesso Group Holdings Limited has established itself as a diversified conglomerate with a wide range of business interests. China Lesso Group Holdings Limited market capitalization of 15 billion is significantly larger than the average industry peer of roughly 0 billion. This shows that China Lesso Group Holdings Limited holds a significant advantage in their industry. China Lesso Group Holdings Limited trades at a higher price-to-earnings ratio of 8 times, and a lower price-to-book ratio of 0.56 times relative within the industry. This shows that investors are pessimistic in the industry in general, and we should dive deeper on the reason. Additionally, the stock appears attractively priced. Investors should evaluate if the business earnings is sustainable and if the assets are valuated rationally. Overall, we need to identify if this makes a good investment on the long term, or is it going to be an extended period of low valuation or a value trap. The leverage on the balance sheet appears elevated, with liabilities of 58% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Average liabilities have increased over the past 5 years, which is normal for a growing company. Asset and equity growth have outpaced liabilities, suggesting balanced and healthy expansion. Shareholder equity has grown consistently, but operating income growth is weak or inconsistent. Equity expansion may be driven by financing activities rather than core business profitability. The company has continued buybacks despite weak revenue growth, raising questions about capital allocation priorities. The company have a dividend yield of 4.05%. The income statement shows that the company revenue have been declining annually and operating income have not been increasing. This shows that the business is under pressure with rising cost and its management is unable to expand the business. The primary drivers of revenue growth or decline can be identified through an analysis of the extracted summaries. Revenue growth is primarily driven by the expansion of new energy business, which saw a staggering increase of 240.4%. The Southern China segment also contributed to revenue growth with a 10.6% increase. Additionally, the sale of goods and services income relating to new energy business experienced a significant jump of 107.3%. On the other hand, revenue decline was observed in the Southern China segment, which saw a 10.9% decrease. The property under development also contributed to revenue decline with a decrease of RMB 283,078,000. Furthermore, the building materials and home improvement business unit experienced an 18.9% decline. The mixed or contradictory information highlights the complexities of revenue growth and decline. For instance, while non-PVC products sales volume increased by 5.9%, revenue from these products decreased by 4.4%. Similarly, PVC products sales volume declined by 1.6%, but revenue from these products decreased by a higher margin of 12.4%. These discrepancies underscore the need for a nuanced understanding of the factors driving revenue growth or decline. Net income for the company decreased by a significant 25.1% to RMB 1,262 million. This decline can be attributed to a combination of factors, including a drop in sales and an increase in initial operating and development expenses related to overseas markets. The impact on profit margins was also notable. While the gross profit margin increased to 27.5%, the EBITDA margin decreased to 16.2%. Most significantly, the net profit margin dropped to 5%. This decline is attributed to a lower selling price and reduced gross profit margin. These changes in net income and profit margins are a result of the company's efforts to expand into overseas markets, which has led to increased expenses. The decrease in sales and lower selling prices have also contributed to the decline in net income and profit margins. Based on the extracted summaries, it appears that there is a discrepancy in the information provided regarding the company's operating cash flow. On one hand, pages 9 and 11 explicitly state that the company has no or negative operating cash flow, with a consolidated figure of $3,167,810 on page 11. However, pages 26 and 44 contradict this statement by claiming that the company is generating positive operating cash flow. Upon closer examination, it becomes clear that the most explicit and reliable source of information is page 11, which states that the company's operating cash flow is negative. Therefore, based on this evidence, it can be concluded that the company is not generating positive operating cash flow. The company's debt level has undergone significant changes in recent years. While total borrowings decreased by RMB 1.7 billion, a small increase of RMB 1,997,677 was recorded elsewhere, resulting in no net change to the overall debt level. This suggests that the decrease and increase balance each other out. In terms of interest expenses, there has been a notable reduction. Interest expenses on bank and other loans decreased by 28.2% from 2024 to 2025, primarily due to an optimized debt structure and partial debt repayment. This indicates that the company has made efforts to manage its debt effectively, resulting in lower interest expenses. The performance of various segments and regions in the market has been mixed, with some areas experiencing significant declines while others have shown growth. In China, the southern region was particularly hard hit, with a minus 10.9% change recorded. This trend was not limited to southern China alone, as other parts of the country also saw a decline of minus 11.4%. These poor performances in China were likely due to various economic and market factors affecting the region. In contrast, regions outside of China have shown resilience, with a plus 2.2% change recorded. This is a significant improvement compared to the decline seen within China. Furthermore, other regions such as Southeast Asia, Africa, and South America have also performed well, indicating that these areas are growing and thriving in the market. Overall, while some parts of the world are struggling, others are experiencing growth and expansion. It will be interesting to see how these trends continue to unfold in the future. Management is optimistic about the company's future growth, citing China's economic recovery as a key driver. To achieve this growth, the company plans to focus on its core operations, optimize its structure, and adjust non-core businesses in environmental protection. In terms of strategy, management has identified several key areas for development. The new energy industry will be targeted at overseas markets due to domestic competition, while the supply chain service platform will be developed prudently to maximize financial returns. Additionally, the company will evaluate, divest, or convert its overseas assets to optimize its financial position. The company also sees opportunities for growth through business cooperation with Kedah in Africa and is exploring new business development opportunities in this region. Overall, management's outlook is positive, driven by a combination of domestic economic recovery and strategic international expansion. The company has a history of distributing its profits to shareholders through dividend payments. In 2024, the company paid out $620,483 as dividends. Furthermore, for the year 2025, the board declared a final dividend of $616,253,000. These actions demonstrate the company's commitment to returning value to its investors. In addition to paying dividends, the company has also received income from equity instruments at fair value through other comprehensive income, FVTOCI. In 2024 and 2025, the company received RMB 16,396,000 and RMB 16,029,000 respectively. These receipts contribute to the company's overall revenue and further highlight its financial performance. the payment of dividends and receipt of income from equity instruments indicate a strong focus on shareholder value creation within the company. Concerns about inventory buildup and supply chain disruption are mounting. The data suggests that manufacturing and trading inventory have seen a significant increase of RMB 96,796, while raw materials inventory has risen by RMB 62,300. This accumulation of inventory may indicate inefficiencies in the production process or an overestimation of demand. Furthermore, there is evidence of supply chain disruption, as over 6 months to 12 months receivables have increased substantially from RMB 0 to RMB 52,169. This indicates that companies are struggling to collect payments from their customers, which can lead to cash flow problems and disrupt the entire supply chain. These issues highlight the need for businesses to reassess their inventory management and payment collection processes to prevent further disruptions. That concludes the financial summary for China Lesso Group Holdings Limited. Feel free to comment below, and I will be happy to answer them when possible.